Hello traders, the title of this video is Wave Trading Education Part 9. If you have not watched Part 1 to Part 8, it's very important that you watch them first before watching this video. In this part of the video, we will discuss how to trade the third Elliott wave. Alright, very, very important. The third Elliott wave allows traders to catch, the bigger part of a wave cycle. It allows also option traders to take a low risk trade for a high reward. Okay, it's also the easiest wave. Though a lot of traders have difficulties to catch the third Elliott wave, it's the easiest wave. But in this video, I want to highlight few points to traders. Practical strategy that traders, wave trading strategy that traders must adopt, guidelines that they must follow, easy steps that they must follow to avoid getting into trouble when they are trying to catch the third Elliott wave. In theory, this is the longest way, the most profitable, rewarding, generous Elliott wave. All right. We are looking at the S&P 500 now. We are on the quarterly chart. I'm using the S&P 500 and also Pufizia stock on a quarterly chart, and we're going to look at it together. If you look on this chart, we can see that the price was going up. If you were on this quarterly chart, all right, for the S&P 500, okay, and suppose we didn't know what has happened in 2000, because I have some line here, okay, suppose you didn't know what was happening in 2000, you didn't know what was happening in 2003, and you didn't know what was happening in 2008, all right, and you are just somebody who was just a purest technical trader using your wave count to make a decision. By the way, in 1999, in 2000, there was what we call the tech bubble. Okay, most of the internet stock, the price was going up. That's what we call a bubble, was going up for nothing. And these bullish trend were not supported by a stronger fundamental. That's what we call a bubble. Price going up for no reasons. Okay, the price going up, and the price not supported by valid, fundamental. It's all about sentiment. It's all about enthusiasm. Anyway, in 2000, the market corrected itself. So before 2000, a lot of tech stock were going up big time. In 2000, okay, if you didn't know before, it's a very important point for all market participants to understand. In year 2000, year 2003, year 2008, and the year 2009. You want to know, okay, these are points. That's why I put a vertical line there for you. So, suppose you were here, all right, you didn't know. So here we know that in 2000 there was a tech bubble which finally burst, so to speak. And the market realized that a lot of tech stock have deviated from their true value, from their core value, from their fair value, so to speak. So if there is a deviation from the fair value, if there is a deviation from the core value, if there is a deviation from the real value of the stock, what usually takes place, ladies and gentlemen? Slowly but gradually, okay, the market will rectify itself. So most of the stock in 2000 went down because they were overbought, okay? They were overpriced, and it was a bubble. They were going up for no reason, and most of the stock was going up without any fundamental reasons. They do not have even some asset. Some of the company was internet company. They do not have any asset at all. And they were not making huge money also, but the price was going up. All right, this is a bubble. But finally, the bubble burst and the price started going down. In 2003, something else has happened. Are you aware of it? This is what we call the commodity, bullish cycle has begun in 2003. So gold and all the metals start going up slowly but gradually in 2003, and the market was following that. In 2007, the market hit, that's what we call, the real estate, financial crisis. You remember in 2007, a lot of property were going up. This time it was not anymore, the tech company. It was the bank, so the bank also couldn't finance their own balance sheet, and also the property, a lot of debt on the balance sheet of the bank, of the financial institution, and the property price was going up too much, and houses that supposed to cost $100 was rate at $200, 3 times their real value. And the bubble of the property also burst in 2007, and we have the financial crisis because the banks were financing all these mortgages, all these loans, and they were not verified, whether those borrowers can afford to pay back the money. Suddenly, everything collapsed, and this was happened in 2007. In 2009, a very important point, this is again another hotspot trading zone for investors to know. And in 2007, the press started printing money and lending also money to the bank at a low interest rate. The interest rate went down even to almost to zero. Japan was the first one. So a lot of banks were borrowing money from Japan and reinvesting in the stock market in United States and around the world, and also the Fed in United States was printing money. In Great Britain also they were printing money. All the central banks were printing money, and there was too much money floating around, and the money should go somewhere, and the bank divert all this money into the stock market. In 2009, the stock market started going up to this point. I want to bring traders' attention to one point that we are watching now, 2016. Before we get there, let me put a spotlight there. We will see what will happen in 2016. That remains to be seen. How do we trade the third area wave? You can see that the price was going up in this session, on the quarterly chart. So now we see that it started pulling back from 2000 up to 2003. So in 2003, we will say, hey, George, this is the third area wave. All right? There's nothing wrong with that for traders to say at this point that it's the third area wave that has begun. But remember what I said to you. We want to give to traders the guidelines, the verification, investigation that they must do if they want to enter the third area wave, if they want to buy and hold for long term, if they think that this is a third area wave that is starting, what verification they need to do. The first thing that trader must do is to go to Google Finance, Yahoo Finance, and to do a proper due diligence. There won't be any third area wave if the fundamentals are not sound. Now repeat, there won't be any third area wave if the fundamentals are not sound. Remember that. It's just one of the verifications you must check. So you see a stock that is, you think that it is starting a third area wave, go to the balance sheet, check the cash flow, compare the short-term then to the short-term liability at least. This is what we call the acid test. Check the return on capital, check the earning yields, and check with the management and see, the competition. Are they coping with the competition? Just be honest, use common sense. Can they remain in the market, all right? Look around, compare them to their peers, and know what is likely to take place, all right? So you want to do, check the fundamental. That's the first verification a trader must do. A trader that is about to enter the third area wave must go to Google Finance, must go to Yahoo Finance to check the balance sheet, the cash flow, and to make sure that the financial instrument, has a strong foundation, financially speaking, all right? That's the first verification. So here we will check the market. We will check if this is a stock, because we are looking at S&P 500. We will check the fundamentals, all right? The next verification that traders might do if they are about to enter the third area wave is to check the market itself, which is the S&P 500. So you see a stock X or stock Y or stock Z about to start the third area wave, all right? You do your verification, the fundamental verification at Yahoo Finance, at Google Finance, you check Bloomberg, or you are trading Forex, you check the Forex factory, you check the GDP of the country, all right? You check, the economic growth of the country, if you are Forex trader, and you are satisfied, great. The first verification, great. We tick the box, okay? Second verification, we want to check the market itself, all right? You want to check the market itself. Because if the fundamental was sound, all right, but the market itself is going to be bearish, we want to be careful. So you will know that there is a risk the market can drag another financial instrument down. So we want to make sure that the market also, okay, macroeconomic speaking, okay, the market is bullish. The market is in a bullish cycle. A financial instrument also has a strong fundamentals and about to start a third area wave. That's great. So first verification, fundamental relating to the financial instrument that we are about to trade. Second verification, aligning the market, the financial instrument with the market itself, checking the cycle of the S&P 500 itself. That's the second verification. Very often, ladies and gentlemen, when the third area wave has begun, is underway, traders get very excited. So suppose you were here, you say, Joe, this is the third area wave. Now it starts going up big time, all right? And the price reaching a resistance level. It's not because the price is in a third area wave that it will definitely break a resistance level. All right? Remember that. So when you are trading the third area wave, price going up, acknowledge the resistance level. So apart from the fundamental, the market, when the third area wave is underway, trader must not disregard the resistance ahead, all right, or the resistance below if you are in a downtrend. So here is going out, we say this is the third area wave, price come here. A conservative area wave trader will say, yes, I think it's the third area wave, but I will take some profit here. I will not buy here. I will wait for the price to break above this key level to find a support above it before going up. The third thing, the next thing that I need to say to traders is that apart from the resistance that the resistance and the support level, depending on the uptrend or the downtrend, that traders must check, which is the third guideline that traders must follow. Traders must also remember, Elliott wave traders must also remember that the second wave can be a normal zigzag, which means the price will go down 1, 2, 3, A, B, C. The second wave can also be, ladies and gentlemen, all right, a flat correction, which means, pay attention. So you think that this is the third area wave that has begun here, but we also know that the second wave can be a flat correction, which means this can be only the A corrective wave of the second wave, and this portion here can only be the B corrective wave of the second wave, which is not yet completed. But the mistake that a lot of area wave traders, they will think that this is a straight second wave, that all second waves should be in a straight move down, but some second wave can be like this, which the price go down like this, and then the price go even above the previous high, only to come back down, okay, talking about the running flat correction, the expanded flat correction, and the normal zigzag. So a lot of traders at this point in time, let me remove some line here because I don't want the video to be too long. I'm speaking fast. My apologies to traders. So at this point in time, a lot of traders say this is the third area where you're definitely going to go up. Some traders may say, okay, it's going to be A, B, C, D, A, B, C, D, breaking this one. But as I said to you, we check the fundamental, we check the market, we are paying attention to the resistance level. So at this point, we must take profit and just pull out. You are an investor long term, you make money from 2003 to 2007. A lot of hedge funds were bankrupted in 2007 because they were buying even here aggressively. They said this is the third wave, and it will definitely go up. It will continue to go up. A lot of option traders, a lot of medium-term traders get into trouble here. But by using the guideline that we are telling you now and acknowledging the resistance level, one will take profit here and watch it. But as you can see, the price found a resistance right there. So if you took your profit, you'll be very happy that you make the right decision and pull back. So we see now 1, 2, 3. We also know that, the minimum price move, talking about the wave principle, is 3. So we see a correction that takes place in 3 waves, 1, 2, 3. Again, displaying a double bottom pattern, we'll give it a chance here. So the fundamental first, the market first, attention to the resistance level. The fourth step that traders must pay attention to when they are trading the fourth area wave, do not forget that the second wave can be a normal zigzag. The second wave can also be a normal flat correction, like this one, A, B, C. The second wave can also be, a running flat correction, which means the B correction wave going above the previous high and coming down 1, 2, 3, 4, 5. So By understanding that, once the third area wave has begun, we see all the time on the hourly chart, on the 4-hour chart, on the 2-hour chart, traders try to catch the third area wave, only to see that a cycle that has begun has failed. So price going up like this, people say, George, I told you, you say it's a triple grain is going to catch the third area wave is begun, and if you fail to acknowledge the resistance level, and you fail to acknowledge the fact that now even the common sense trend line here is kaput, and you are forcing it, you can be in trouble. So by understanding, okay, the formation of the second wave, the second wave can be a normal, okay, flat correction, can be a normal zigzag, can be a running flat correction, but the second wave in theory cannot be A, B, C, D, E. That's the theory. The reality of the market can be a messy one, but I do not use the theory like a science. All right? So you want to understand that though we see it like this, as we are catching the third, it's supposed to be the third area wave here, we are also watching the resistance level and also reminding ourselves that, look, it may not be finished here. The second wave may not finish yet. As we can see, it was not finished here. A lot of hedge fund thought that it was the third area wave still continuing here. By forcing the Elliott wave, by disregarding the price itself, a lot of investors get into trouble here. To summarize what traders need to do when they are verification that they must follow, the guideline that they must follow when they are trading the third area wave. First, check the fundamental or the financial instrument that you are trading. Second, align, okay? Check the market itself, which is the S&P 500, to have a harmonious signal or harmonious trade. Third, do not ignore the resistance and the support level. Fourth, remember the second wave can be a zigzag, a flat, okay, and also can be a running flat correction. We do not see A, B, C, D, E, a triangle in the second wave. So when you are catching a third area wave like here, a lot of traders will see, George, we definitely going to go up, all right? They start doing using their wave genius, projecting their channels of the consolidation to the upside, trying to catch Elliott wave. I hope you have learned something from this video about how to trade the third area wave. The most important thing trader must remember is that there won't be any third area wave if the fundamentals are not solid. Remember that the third area wave can also be divided into 5 waves, so it's not always in one straight line, going up straight in one line. So the third wave can be divided into 5 ways, so the price go up a bit, acknowledge the resistance, pull back a bit. We may have the third subwave of the third wave itself, which is a complex third wave, as the price going up. Remember that the third area wave can also be divided into, okay, a sub-wave. But the key point trader must understand that if there is no strong fundamental, technically speaking, we may see the beginning of the third area wave, but that third area wave can easily fail. As you can see here, in 2007, the supposed to be the third area wave has failed because of what? Okay, the financial crisis of 2007 and 2008 and the real estate bubble. As always, traders must combine the wave trading, the wave principle, the technical analysis with the fundamental, okay, to make viable trading decision. To know more about fundamental trading, traders must go to Google Finance, Yahoo Finance, Forex Factory, Bloomberg.com, and Financial Times. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders. This is the Wave Education, Part 9. Thank you for watching, and we will speak to you very soon.